The credit card trio, the three key pillars that shape credit cards: payments, interest, and fees. Today, we're exploring part 2, helping you understand how credit card interest works. Interest charges, the silent cost of borrowing. If you carry a balance from month to month, your card issuer applies interest based on your annual percentage rate, APR. But did you know that, along with your carried over balance, all new purchases begin accruing interest from the day they are posted to your account? Understanding this topic will help you make credit cards work for you without falling into costly expenses. Stick with me till the end. This is advice you won't want to miss. In this channel, we'll break down everything you need to know about credit card success made easy, one lesson at a time. Your credit card transactions are subject to an interest rate called the annual percentage rate, APR, which represents the cost of borrowing money. Card issuers apply different APRs depending on the type of transaction, your creditworthiness, and the terms outlined in your credit card agreement. I'll delve into the types of APRs applied to your credit card in another video. For now, let's focus on the 4 methods used to calculate credit card interest. Average daily balance method. The interest is calculated based on the average daily balance, multiplied by the daily interest rate, to determine how much interest you pay over the entire billing cycle. This is the industry standard for credit card interest calculations. Credit card issuers may calculate the average daily balance with or without compounding interest, though compounding interest is the most widely used approach. Daily balance method. The interest is calculated based on the daily balance, multiplied by the daily interest rate, to determine how much interest you pay over the entire billing cycle. This method is used by some credit card issuers, but is less common than the average daily balance method as it tends to result in higher interest charges. Adjusted balance method. The interest is calculated based on the balance at the end of the billing cycle, after payments and credits have been applied to the account. This method is less frequently used, as it benefits cardholders by reducing interest charges. Previous balance method. The interest is calculated based on the outstanding balance at the beginning of the billing cycle, before any payments or charges are applied. This method can lead to higher interest charges, since payments made during the billing cycle do not reduce the balance used for interest calculation. For that reason, this method is rarely used. Since the average daily balance method is widely used by financial institutions, and if you carry a balance, it is most likely applied to you, we will delve into its details, including how it works with or without compounding interest. But first, let me explain a few important concepts. Daily interest rate, also known as the daily periodic rate. This is the rate at which interest is calculated on your outstanding balance each day. It is derived from the annual percentage rate, APR, typically divided by 365 days. For example, if the APR is 18.99%, the daily interest rate is 18.99% divided by 365, or 0.0520%. This percentage value is crucial because it determines how much interest you will pay if you carry a balance on your credit card. Billing cycle. This is the period during which your transactions are recorded. It typically lasts 28 to 31 days, depending on the month, but does not necessarily align with calendar months. Revolving balance. This refers to the outstanding balance a cardholder carries over from one billing cycle to the next. Compound interest. Interest is calculated not only on the outstanding balance, but also on the accumulated interest from previous days. In other words, it's interest on interest, which leads to faster debt growth. Average daily balance. This is calculated by summing the card's daily balance from the first day of your monthly billing cycle through the last day and then dividing the total by the number of days in the billing cycle. Let's explore how the average daily balance method with compounding interest works. First, at the end of each day, the daily balance is multiplied by the daily interest rate to calculate the daily interest charge. Second, the end-of-day balance is determined using the formula daily balance plus new charges, such as purchases and fees, minus payments and statement credits, plus the daily interest charge. This end-of-day balance becomes the daily balance for the next day. Third, the sum of all daily balances is divided by the number of days in the billing cycle to determine the average daily balance. Finally, the average daily balance is multiplied by the daily interest rate and the number of days in the billing cycle to calculate the total interest charge. Let's check the calculations with the following hypothetical scenario. Revolving balance, $4,000. APR, 18.99%. Billing cycle, 30 days. Daily interest rate, 18.99% divided by 365 days equals to 0.0520%. The daily balance on day 1 is the revolving balance. No charges or payments are applied. At the end of day 1, the daily interest charge is calculated by multiplying $4,000 by 0.0520% and then added to the end-of-day balance. On day 2, the end-of-day balance from day 1 becomes the daily balance. Again, no charges or payments are applied. At the end of day 2, the daily interest charge is calculated by multiplying $4,002.08 by 0.0520% and then added to the end-of-day balance. You can see how the daily interest charge silently increases the daily balance each day. On day 10, a new purchase of $100 is made. This amount, along with the daily interest charge, will be added to the end-of-day balance. This purchase contributes to the daily interest calculation the next day, which is a consequence of losing the grace period by carrying a balance. On day 20, another purchase of $200 is made. This amount, along with the daily interest charge, will be added to the end-of-day balance. This purchase also immediately affects the daily interest calculation the next day. On day 30, a payment of $300 is made. However, the payment is applied to the end-of-day balance after the daily interest charge is calculated. Since day 30 is the end of the billing cycle, the average daily balance is calculated by summing the daily balances from day 1 to day 30 and dividing the result by 30 days. This equals $4,164.14. Additionally, the daily interest rate is used to calculate the interest charge for the billing cycle by multiplying $4,164.14 by 0.0520%. This results in $2.17, which is then multiplied by 30 days. This equals $64.99 in interest charges for the billing cycle, which are added to the daily balance on day 31, the beginning of a new billing cycle. Please note that if you add up the daily interest charges from day 1 to day 30, you will get the exact same result as the interest charges for the billing cycle. One thing stands out in this scenario. The payment made during the billing cycle was equal to the dollar amount of new purchases, which essentially left the same revolving balance from day 1 plus interest as the new daily balance for the next billing cycle. This means that if your payment is less than or equal to your new purchases during the billing cycle, your revolving balance will continue to grow indefinitely. As for the average daily balance method without compounding, it works almost the same way as the method with compounding, except that it does not factor in daily interest calculation when determining daily balances. As a result, the average daily balance and interest charge for the billing cycle are lower than they would be with compounding. In practice, credit card issuers may apply slight variations to both methods. If all these calculations feel overwhelming, don't worry, I've got you. Understanding interest calculations can get extremely complicated. All you need to know is that when you carry a balance from month to month, interest charges will silently add up to your balance and can sometimes catch you by surprise, as compounding interest can quickly drain your finances. The best approach? Pay your statement balance in full every month. If you found this information helpful, explore the videos below to continue your journey toward credit card mastery. Don't miss out. Remember to hit the like button and subscribe to our channel so you stay updated on the latest tips and insights. We'd love to hear your experiences with credit cards. Share your story in the comments below. Thank you for watching.